If you are thinking of or in the process of starting a nonprofit, some of the nonprofit jargon that you might encounter along the way could leave you scratching your head. So in this video, I'm going to share 10 nonprofit startup terms that you may or may not have heard of before, but are definitely words you should know to successfully start and grow a nonprofit organization. Welcome back. My name is Amber Melanie Smith, and I'm a nonprofit founder and executive director who loves making these videos here on YouTube to help folks who want to make an impact, whether that is by starting a nonprofit or working for a nonprofit, starting a social enterprise or socially conscious business, and other avenues to create positive social change. As always, I hope that you find this video useful and helpful. Don't forget to give it a like and subscribe to my channel for more content like this. And check out my website, foundertofulltime.com, where I have some online courses that are helping folks with the process of starting a nonprofit and the process of developing a sustainable fundraising plan for their new organization. All right, are you ready to test your knowledge? I'm going to get into these 10 terms now, and I would love to hear at the end how many of these you knew and got right, and which ones were the most confusing. Let's get into it. Okay, term number 1 is fiscal sponsor. A fiscal sponsor is another nonprofit organization who basically partners with a new nonprofit startup to let it borrow its official established 501c3 status and operate under it for some administrative and management support while it's getting itself up and running. Not any organization can be a fiscal sponsor of a new startup nonprofit. The fiscal sponsor organization and the new nonprofit startup have to have missions that are really, really well aligned. So you want to really vet a partner before you fall under the fiscal sponsorship of another organization. Fiscal sponsor organizations can do things for a startup like allow donations to be made to the new startup using the fiscal sponsor's current donation and tax-exempt status setup. They might provide some management guidance or support or administrative support when you're sharing resources like an office or software, for example. You don't have to get those resources yourself as a startup. So the reason that another organization might be willing to be a fiscal sponsor for a new startup is if those missions are really aligned, like I said. If the new startup is going to do something that's going to be very complementary to the existing organization, and so its success is an important part of the established organization's success. The second term is direct service. Direct service. So this is when an organization has programming or activities that directly work with the intended population. So for example, when an organization is managing like a soup kitchen or running an animal shelter or animal like fostering or adoption agency, or tutoring youth, you're working directly with the population being served. This is different from some nonprofits who focus more on research, outreach, or advocacy, which are also really important missions. The thing about direct service versus indirect service is not one is good or bad over the other. They're both really needed to create long-term social change. You've got to have people providing those direct services like feeding people and housing stray animals and stuff like that, while also having other people work on uprooting the systems that are perpetuating those social problems in the first place. So why do we have hunger still in the world when we have plenty of food to eat in theory? Well, someone's got to be working on that problem while someone is also feeding people day to day. The third term I'm going to cover is IRS Form 990. I know it can be exciting to think that once you have filed for your nonprofit status and gotten all of that paperwork out of the way, that you don't have to file any more paperwork ever again. But unfortunately, that is just not the case. Especially if you're a nonprofit in the United States, you have to file the Form 990 each year to prove to the IRS that you are still complying with the Internal Revenue Code that applies to your nonprofit status and tax exemption. The easiest way to think about the 990 is it's basically your nonprofit organization's annual tax return forms. So on your 990, you're going to need to include things like your assets, your receipts, the compensation of your highest paid staff or officers of the organization. You can technically fill out the 990 yourself. There's no rule against it, but many organizations do hire an accountant to take care of this for peace of mind. The fourth term I'm going to cover is general operating support. General operating support. This is when a magical donor gives a contribution that is intended to cover the organization's day-to-day costs. This can be anything from ongoing expenses or office supplies or salaries, utilities, rent for your organization's space, etc., etc. These are unrestricted donations, which means you can use it for these day-to-day needs, but you can also decide if you need to use these funds for emergencies or urgent needs that come up related to any aspect of your organization's work. The fifth term is bylaws. And depending on where you are in the process of starting a nonprofit, you might already have these bylaws completed, or you might be just now figuring out how to complete them. Let's start with what they are. Bylaws are a written document that outline your organization's basic governance and operating procedures. Creating bylaws is something that, at least in the United States, is required by law in order to get your official nonprofit status. So all organizations have to have bylaws. These organization bylaws will typically include things like the minimum number of board of directors members you're going to have, what their roles and responsibilities are on a basic level, how do you hold meetings, how frequently do you hold board meetings, what is your process for electing new board of directors members if someone leaves the board, and what a board term is. So, organizations to stay healthy and always have, a lot of perspectives and be truly representative of the community should have board terms of maybe a couple of years tops, so that new board members can come in and lend their fresh ideas too. So what are those board terms? That would be in the bylaws. It would also outline things like the conflict of interest policy and other important key policies that your organization might be operating by. You do have to have these, as I said, to get your official status, and you also have to update the IRS if you make any significant changes to them. You just send in a bylaw amendment. Okay, term number 6 is days cash on hand. Days cash on hand. Hopefully you can kind of figure out what this is by what it sounds like. So days cash on hand is basically how many days your organization could continue to operate and pay its obligated or expected bills based on how much cash you literally have in your bank account right now. The purpose of this metric is to basically assess the short-term financial health of your organization. Are you about to go under because you only have 10 days cash on hand, for example? It's really healthy to have at least a couple of months of days cash on hand or operating costs in the bank accounts that you can, be thinking ahead and making sure you can pay your bills that you're expected to pay. But several months, days cash on hand is even better. All right. Number 7 is strategic plan. Strategic plan. A strategic plan is a written document that maps out your organization's step-by-step process to basically achieve its mission. So at minimum, this strategic plan is going to include your ultimate outcomes or goals, such as how many people will you serve or what % of a population will you serve and how. It will include your specific strategies or tactics in order to reach those outcomes or goals. How are you going to reach all those people? How are you going to serve all those people? The resources that you need in order to enact those strategies to meet your outcomes, and then how you're going to get those resources. And resources could be things like money, it could be technology, it could be the right talent on your team, it could be any of these things. Typically, you would sit down with your leadership team. It could be your board of directors, it could be your staff and board of directors if you have staff, but whomever is responsible for making decisions in your organization. And I also encourage organizations to include, non-leadership staff too, who might have insights about things they're seeing on the ground as they're enacting your programs that might be helpful to developing a strategic plan. So including all these people, collaborating together, thinking through what does the organization need over the next several years and what are the best strategies to get there. Writing all this down in a document, and this is your guide. This is your map for how you're going to achieve your mission. It's one thing to say we're going to end hunger in my city, another thing to have an actual strategy and a plan to make it happen. You might have short-term strategic plans that last 1 or 2 years, and then slightly longer-term strategic plans that last 3 to 5 years. But it is important to keep going back and looking at them and refreshing them because the world changes and your organization has to evolve too. All right, number 8 is kind of 2 terms rolled into one, and it's cash versus accrual basis of accounting. Nonprofits really need to have accurate accounting and strong accounting practices for many reasons, but one of them is that Form 990 that I mentioned earlier has to be accurate. The IRS could audit your organization at any time, so you really want to make sure that you're keeping great financial records and that they are accurate and up to date. When you're a startup, this begins with choosing your method of accounting. It's either cash basis or accrual basis. And I know many startups choose the cash basis because it's a little bit more simple and makes a lot more sense when you don't have as many financial transactions coming in or out at a given time. So here's the difference between them. The cash basis of accounting is going to focus on reporting the transactions in the period in which they actually happen. So let's say a donor promises that you're going to get a donation, and they promise this on March 1st, but they put it in the mail and it takes a month to get to you, and you don't actually get the donation check in your hands until April 1st. Well, then you'd be putting it into your bank account, and under the cash basis of accounting, you'd be counting that money in your hands as of April 1st, not March 1st. So it's basically when you literally have the cash in your hands. On the other hand, the accrual basis of accounting generally focuses on reporting transactions when they're anticipated to happen. So let's say that same donor promises the donation on March 1st. You might put in your accounting system that you are expecting that donation as of March 1st. Instead of just logging when the cash actually arrives in the bank account, you would be logging when you know it's expected. It's a way of anticipating your expenses and your income over a longer period of time. If there are any accountants watching, please weigh in with any nuance here that I might have missed, because I am not an accountant, but I have been working in my own organization's finances for several years. Term number 9 that we're going to cover is earned revenue / earned income. About the same thing. So earned revenue or income is basically when a nonprofit generates money by providing goods or services. So an example that you might be familiar with is a nonprofit art museum or a nonprofit theater selling tickets to its exhibits or performances. That would be earned income. This is different from a contribution because a contribution is made by a donor who's not expecting anything material in return. They're not expecting a good or a service in exchange for their donation. It's simply a gift. Many nonprofits generate a significant portion of their annual income through earned revenue or earned income. But the trick here is that it can't just be any goods or services that you sell. If you sell, if you bring in too much revenue, based on selling goods or services that have nothing to do with your mission, then the IRS might say, well, this is unrelated business. It's not related to your mission, and we're going to tax you on it. So to avoid that penalty for unrelated business income, your earned income strategy should really focus on selling goods or services that directly further your mission. I talk about this a lot in one of my other videos that's specifically about earned income, but basically you want to think about your mission. Let's say it is to help young women become entrepreneurs, and you happen to be the Girl Scouts. Well, then selling Girl Scout cookies and having the kids learn sales and marketing and all that is teaching them to be entrepreneurs. Thus, it is an earned income strategy that would not be considered unrelated business. Boom. Okay, the final one, number 10, is overhead or infrastructure costs. Overhead or infrastructure costs. Overhead costs are the costs for items or salaries relating to the management, administration, or fundraising for your organization. Overhead has had a negative connotation in the past, and if you've seen many of my videos, I've talked about this several times. But many people are realizing that overhead often relates to those really critical things an organization has to have in order to run effectively and smoothly. For example, if you run a shelter for people experiencing homelessness, then the rent on your building should not be unnecessary overhead, because you can't fulfill your mission of helping people experiencing homelessness and giving them shelter without a building. So it should be related. It's not just a utilities cost. A lot of people think that just all salaries for a nonprofit are part of overhead, but that is not true. That is a misconception. If any staff member is spending any time on fulfilling the mission through your programs, if they're working on a programs related task, that time being spent is a programs cost, not an administrative or fundraising cost. So dividing up the staff time and their salaries based on the amount of time that they're spending on the different activities of the organization is the right way to do it. It's not that one person, let's say the executive director, is not just all overhead. If they're spending a third of their time on programs or supporting programs, then a third of their time is a programs cost. There's a lot more nuance here that we could get into, but trying to keep this video done in a timely manner. So I'm going to wrap it up here. Okay, it's the moment of truth. How many of the 10 did you get right? I would love to hear which ones were the most obvious, which ones were the easiest for you, and which ones had you not heard of before. Share in the comments below. As I mentioned before, if you are in the process of starting a nonprofit or creating your fundraising strategy, I have some great online courses at my website, foundertofulltime.com. You can find those there. I have one all about the process of starting a nonprofit, and another one about how do you actually start creating a sustainable fundraising plan or strategy. So check those out. I have a newsletter for changemakers and nonprofit leaders. You can subscribe to that using the link below this video and opt out anytime you like. And finally, I have a Facebook group called Change the World or Bust. We've got 4,000 plus people in there from around the world now who are all trying to make an impact in their own way. And we're just talking to each other, getting some support and guidance from each other on our journeys. So I hope you can join us there too. Once again, my name is Amber Melanie Smith, and I hope to see you next time.